Hey there, welcome back to my channel. Did you know that it is not legally permissible to register your South African private practice as a PTY Limited? Now, don't stress if you didn't know that. I know lots of health professionals who are currently registered as such when they're not supposed to be. So recently I hosted a live masterclass with Goldberg, who is the director of Inaura Chartered Accountants. They are specialists in medical accounting, and he shared some important considerations you should be taking when starting a private practice, such as the pros and cons of different types of business entities, like whether you should be trading as a sole prop or whether you should register an Inc. or a partnership. And he also spoke about understanding the various tax functions of your business and how to be most tax efficient. If you're new here, hi, I'm Tasneem Abrahams. I'm the founder of the Private Practice Growth Club. If you like this kind of content, don't forget to like, subscribe, and to hit the bell notifications if you want to be notified of new videos. Let's get into it.
The main differences between the sole proprietors and Inc. I've summarized here on this table. So sole proprietor, yourself and the business are the same legal entity. If you're running an incorporation, the incorporation is registered as a separate legal entity from yourself. The sole proprietor, you are personally liable for all the business's debts. As an incorporation, that is actually, it's the same. You're also going to be responsible for all your business's debts. There are no legal requirements to register a business for a sole prop. However, if you are running an incorporation, you will register a company with the CIPC, and you will have to file annual returns to the CIPC to keep the company registered. From a tax point of view, you will be taxed in your own personal name as a sole proprietor according to the sliding scales, and you will also be required to register for provisional tax and pay provisional tax twice a year. With an incorporation, you will also have to pay provisional tax twice a year, and you will still file your own personal tax return then as normal as you would, because the incorporation will be paying you a salary as an employee. So you will then file a tax return for the Inc. and for you yourself. The actual tax rates that are applicable, as I discussed before, as if you're running as a sole prop, you'll be taxed according to the tax tables for individuals as per SARS. The Inc. is taxed at a flat 28% unless you are registered for small business tax, which I will get into later, which is a very, very important structuring tool from a tax point of view. And just to be aware that the type of tax return that you file will be an RTR 12. I hope your accountant is aware of them. As a sole proprietor, you'll file an RTR 12 for your company. As an incorporation, you'll file what's called an RTR 14. And lastly, there are no dividends tax applicable to a sole proprietor, and there will be dividends tax payable if you distribute profits if you're running an incorporation. So those are it's a summary of the important differences between the two. I'm going to skip through. I've got a couple of scenarios. I'm actually going to skip through them. I'm going to skip to the end and just kind of summarize the important parts. But effectively, this is more or less what I say to all my clients. But what is the real difference between a sole prop and an Inc? So what happens is, if you're running as a sole proprietor or an Inc, without small business tax, the tax regimes of the two will come in very, very close, meaning you will be taxed very much at the same rate, whether you're running a sole prop or an Inc, unless you're registered for small business tax. So on the next screen, you can see if you're running an incorporation, what does small business tax mean? Is that you taxed at a sliding scale, and your first R500,000 of profit in the company is very, very tax efficient. So as you can see there, the first 79,000 is free. The next kind of 200,000 is taxed at 7%, and so on. What does that mean? Is you lead to a saving of about 95,000 Rand a year in tax if your incorporation is registered for small business tax. So how do you get that right? Is you need to take advantage of the 4 criteria that I'm showing at the bottom of the screen here. So you must have 3 or more employees. You must be the only shareholder of your you can only own shares in that incorporation, meaning you can't own shares in another private company. Your turnover must be less than 20 million Rand, and all shareholders must be natural persons, meaning a company cannot hold shares in your Inc. So what we normally encourage is initially, as I've said, you start off as a sole proprietor because you're taxed at the individual tax rate. So if I go back to the screen over here, you can see that obviously the tax gets more expensive as your sole proprietor would earn more money. So what we encourage is, as you're starting off, it's from a tax point of view cheaper to run as a sole prop, and obviously cheaper because you don't have any company registrations or any of that type of thing. And as the business grows and you obviously gain employees and you gain traction, we will then suggest that you switch over to an incorporation and register for small business tax, and that way you can move over to a cheaper tax regime as your tax brackets as a sole proprietor get higher. You can take advantage of the small business tax that runs through an incorporation. So that's in summary how we would structure it from our point of view with our clients. So a couple of things. Tasneem, are there any questions at this stage?
Yes, somebody is asking, is there any particular reason tax is paid twice a year?
Yeah, so effectively, if you're earning anything but a salary, you will, so basically any income other than actual structured salaried income, you have to register for provisional tax from a SARS point of view. So once you're registered as a provisional taxpayer, your requirements are to now file for tax twice a year. So, I mean, it could be anything. It doesn't just mean private income from a medical practice, but if you're earning, I don't know, rental income or dividend income from shares or interest, a lot of interest income from investments, SARS would require you to file a provisional tax twice a year. So as soon as you've kind of fallen out of your normal salaried category, you would have to register for provisional tax.
Okay, thank you so much.
So just some quick considerations upon startup of a practice. So who should I bank with and why does it matter? So ironically, which bank you choose actually can cause a lot of headaches down the road or not. So some of the banks have actual divisions that specialize in dealing with medical practitioners, so they know kind of at least the industry and what they're dealing with. So if you need to finance equipment or I don't know, normally when you switch from a sole proprietor to an Inc., you'll have to move medical aids and re-register with BHF, and depending on what bank you're with, they can take a lot of admin off your hands. It just makes a hell of a big difference if they understand the industry. Actually, particularly from a financing point of view, you're more likely to get financing from a bank that deals with medical practitioners regularly. FNB is quite good, Investec is very good, but they really understand the industry and can help you later on when you really need it. So just things to consider. So when you're opening a business bank account, I wouldn't just choose the bank you're with. I would investigate a little bit further. Billing company is also very, very, very important. I've seen this go wrong quite a few times as well. So people will either use external billing companies or have someone that will assist them in-house. Either way, I wouldn't just go with the cheapest option. If you're going in-house, it's very important that you make sure that you choose someone with experience or train them up very well. If they aren't collecting timeously, it'll very, very heavily impact the cash flows of your practice. Just some things to consider is the billing companies generally are negotiable. So just make sure that you're only paying for money actually collected, so money coming into the bank account, not on actual patients invoiced. And you can negotiate better rates as your practice grows. So it's just, I've seen a lot of guys go for the cheapest option. It's not always the best. And yeah, I mean, you're most welcome to chat with me or email me. But I can tell you kind of who works the best in the industry, who gives the best service, but it's a big consideration. So I'm just going to talk about tax efficiency. So just either way, you'll probably be drawing some sort of salary, whether you're running it as a sole proprietor or an incorporation. You need to make sure that you're drawing a salary at a reasonable rate. So what does that mean is don't just draw all your profits out as a salary. There's more efficient ways to take the money out of your business. So your accountant should structure your salary at a point that just covers the right amount of expenses, which I'll get into shortly. If you're running as an incorporation, I've touched on already, small business tax is key. And another big consideration is if you have a spouse or family members working in your practice, it can be very efficient to help them structure a salary as well. So what does that mean is if your spouse is working in your practice, you don't have to just pay them a very small salary according to the job they're doing. You can pay them whatever you want to pay them. And it will help to effectively reduce. You can take less of a salary and give them effectively a larger salary and move the two of you into a more reasonable bracket. Instead of you paying yourself a salary in a very high bracket and your spouse in a very low one, you can even out the two brackets between the two. So that's a very important consideration. Dividends tax. So if you're running an incorporation, dividends tax is sitting at 20%. It can be a very efficient way of drawing money out the business, depending on your salary bracket. So just to be aware that does exist, and it should be used probably once a year to draw profits out. I'll get into it later, but you've got to be sure that all the expenses that are possibly deductible for your practice are running through the practice. So as a small example, your cell phone shouldn't be running off your personal account. Your cell phone should be running off your business account. You rather not use an after-tax event like a salary to pay for a cell phone. You rather run it through the company, which will be a pre-tax event. And just be aware that there's, depending on whether your practice is registered for VAT or pay as you earn or UIF, and there's also provisional taxes, there's multiple returns that are submitted throughout the year. So you just need to be aware that it's just not one or two returns being submitted. Your accountant should be submitting all the relevant returns. For instance, pay as you earn is submitted monthly. So I've seen a lot of interest and penalties happen because the practitioners are not aware of the multiple returns being submitted. There's different tax types and all the returns need to be up to date. So the slide just kind of speaks to that. I'm not going to run through all the tax types now, but just be aware there's multiple tax types with multiple deadlines. And for every tax deadline you miss, there will be interest and penalties charged. So just please be aware that you need to submit multiple returns. The legal structure of a practice is also very important, both from a legal point of view and a tax point of view. So if you have partners in the business or there's different shareholdings, you can set up as an incorporation, you can set up as a partnership or a sole proprietor, but all of these different structures have different tax effects. So before you just put the ladder against the wrong wall, you need to consult your practitioner and just be sure that you're setting up your structure from the right tax and legal point of view, because changing later on is quite a headache. So you just need to be sure that you've structured your practice correctly from the outset. I'm going to run through this very quickly, but as we've discussed, there's provisional taxes is compulsory for guys running private practices. So you will be paying provisional taxes twice a year. How is provisional tax calculated? So your first provisional payment will be in August. That's calculated based on profits between March and the end of July, so 6 months. This is grossed up for 12 months and then halved, and you'll pay effectively a half-year figure for the profits that you've earned in August. And then the same thing happens in February. So in February, we will estimate an 11-month figure, so a figure running from March till the end of January, and you will effectively pay an 11-month estimate on your taxes. So the main thing to be aware of here is that your provisional tax submissions, both in August and in February, need to be 90% accurate. Otherwise, there will be interest and penalties. So you can't just pay tax on any figure. The estimates need to be very accurate. So what that leads to is your accountant should be furnishing you with monthly accounts, and you should have an idea of what your taxes are at the end of each period and be tracking that monthly. So the next biggest question I get is probably, when should I register for VAT? So VAT registration is probably from the outset one of the most important considerations. So VAT and medical, I must be honest with you, is not a great mixture. You will pay a lot of VAT once registered as a medical practitioner. There's very little relief from a VAT point of view. So typically what we try and do is delay the VAT registration as long as possible from our point of view. So when should you register for VAT? That's when your incorporation or sole prop reaches R1 million in turnover, is when you should legally register for VAT. VAT is calculated at 15% of revenue, less 15% of the allowable expenses. So the problem with medical practices is there's very little allowable expenditure that's deductible from a VAT point of view. So the biggest cost line item in a medical practice is typically salaries, and that isn't a VATable event. So you'll end up actually paying on average about 10% of your income goes to the taxman from a VAT point of view. So the timing is critical. So obviously when you've set up a practice, cash flows are quite tight. So delaying the VAT process is actually is key from an accounting point of view. So what we normally do is we'll register practice as a sole proprietor. We'll start you off as a sole prop. And once that practice reaches R1 million, we'll actually at that point switch you over to an incorporation, and the VAT limit in an incorporation actually resets. So you've got the opportunity in your practice to run up to R1 million again. And once the incorporation has then reached R1 million, we'll then register you for VAT. So what does that do? Is that normally will buy you an additional year before you VAT register and start paying, 10% of your revenue over to SARS. And at least, you can then hold on to the cash flow when your practice needs it the most. So like I've said in point 3 there, early registration can actually really, really hinder the growth of your practice. So whoever it is that you choose to be your accountant just needs to be aware to delay that impact as long as possible. Cool. So what expenditure can I deduct from my practice? I'm going to skip actually right across to this slide here. So I always talk about pre-tax and post-tax events. So you will be earning a salary either from your sole prop or your Inc. The goal is to deduct as many expenses as humanly possible from your business. So that means moving telephone, internet, cell phone, car expenses. All of those type of expenses need to move over into your practice. So if SARS allows it as a deduction, you need to take advantage of it. That's why you can afford to possibly take slightly less of a salary and bring yourself into a lower tax bracket, because you will be moving some of the burdens that your salary would then take care of into the practice. So I've got like a brief summary on the left-hand side of what would be deductible. And the goal is to try and move as many of your expenses into your practice as humanly possible. Typically items that will never be deductible that SARS looks out for will be your bonds, your personal insurances, groceries, clothing, if you have non-business vehicles, and school fees, which again brings me to the point that if you perhaps have a spouse that's working in the practice, you'll be paying them a salary and they can perhaps then take on the burden of school fees or clothing. So you've got a salary deduction in the business where you normally wouldn't, and that deduction can then go towards paying school fees, etc. So it's very, very important that you move the right expenses over into the practice from the outset, and pay for as much as possible with as little as possible with your post-tax money. Paying with post-tax money effectively means it's 30 to 40% more expensive.
Ryan, I have another question here. How would provisional tax be affected by something like COVID that influences your income drastically? Example, paid high provisional tax based on past income and now income has dropped.
Okay, so interesting question. So SARS have actually at the moment, it's right at the end of the presentation, but what they've done is they've actually given relief for provisional tax, which would now come up in August. So look, unfortunately, if you've already paid provisional tax, so paid the provisional tax pre-COVID, it will only impact your next provisional tax payment. But SARS have allowed an 85% deferral of your provisional taxes now. So for instance, in August that's coming up, you would effectively only pay 15% of what's due. So your income between March and the end of July would probably be drastically reduced anyway. So you're only going to submit to SARS your reduced income, but even then, that profit that you're showing, you can defer 85% of that profit to a later period. So there should in theory for your practice be very little impact or very little tax impact. Most of it will be deferred. But I mean, the short answer is your figures should reflect the reduced trading already. And if it doesn't, you can defer that payment 6 months into the future.
Okay, thank you.
Okay, cool. So I'm going to talk a little bit about retirement annuities. At the moment, because the markets have been hit, retirement annuities, if you're planning on staying in the country, aren't the worst idea, because the underlying of retirement annuities is actually shares. So an investment in them while the shares are low might yield a very good investment later. But effectively, as an accountant, we normally use this as a tax vehicle. So what is a retirement annuity? It's a retirement fund as classified by the Pension Fund Act. What is it for really is, instead of what would happen in a normal workplace where a boss would contribute to a pension fund on your behalf, you contributing to a fund on your own behalf. And there's beneficial tax consequences for this. So as a sole proprietor, your RA effectively is a tax planning tool. So when you're trading as a sole prop, you can view an RA as an additional expense effectively. So anything you contribute to your retirement annuity effectively is a deduction off of your profits, and goes into your retirement fund. So basically it's a direct deduction against income as a sole proprietor. If you're trading as an incorporation, it really, because you're going to be earning a pretty much a formal salary out of your incorporation, it can be seen as a pay-as-you-earn refund. So any amount that you put towards your retirement annuity is refunding any of the pay-as-you-earn that you paid on your own behalf during the year. Just to run through, so you're only eligible to withdraw from a retirement annuity from 55 on, or if you have to stop working due to ill health. You can withdraw your retirement annuity upon immigration. However, it's a very, very expensive process. There's withdrawal taxes and possibly fund-specific penalties if you're withdrawing due to immigration. So just before you put that ladder against that wall and start contributing, you just need to be sure that you are going to be in the country for the foreseeable future, because it's a retirement tool for South Africa itself. It's not really a retirement tool for anywhere else. So just a consideration. So how does an RA work? You can basically deduct a maximum of 27.5% of taxable income, or 350,000 Rand, whichever is the higher of the two. So that's your overall deduction limit. If you go over the deduction limit, so if you contribute more than the 350,000 Rand per annum to this fund, when you do withdraw your retirement annuity upon retirement, there are taxes to pay at that point. Any amount you've contributed over and above the 350 per annum will be applied to your withdrawal after retirement. Please also note that it's not 350,000 Rand per fund, it's in total. So if you're contributing to different funds, the aggregated total deduction you can have is 350,000. But ultimately you will have a full deduction post-retirement. So the last slide I'm going to get into is COVID-19. So this has obviously been very much the talking point, and it's probably taken up 80% of my time over the last couple of months. So I'm just going to run through what we've seen from our side of the various reliefs and the best places to go. So what we found, although the amounts are quite small, the UIF/TERS relief that the government has now put in place is probably the best and easiest way to get money. So what does that mean is, if you pay salaries on your own behalf for employees and you've been contributing to UIF, you're eligible to claim from the UIF fund, provided your practice has been COVID impacted. So all the employees that qualify, what does a qualifying employee mean is that you've contributed to UIF on their behalf and they are a valid either South African citizen or have a valid work permit in this country. The UIF will pay a portion of the salary on your behalf. So even if you can only afford 50% of salaries, the UIF will cover an additional portion should you wish. So as long as your practice has been COVID impacted, you yourself or your accountant can apply to the UIF for help, and they'll assist you in paying a portion of the salaries. We found that this is very beneficial, particularly for the practices that have multiple employees. It really can help assist with guys that have been cash strapped during this time. The other major thing is we found that the relief funds, the SME relief funds that have been put in place, a lot of them have run out of capacity. So what the government did was they gave about 200 billion Rand to the banks, and the banks are kind of assisting with low interest COVID loans. So they're basically administering government loans for them. So you would apply effectively directly to your banker for a COVID loan. It's a very, very low interest loan. There are requirements that will have to be met. For instance, your practice will need to be tax compliant. It'll need to be, it must have a good credit score, etc. But if you do meet these requirements, the bank will be able to issue you with a very low interest loan, with some of the banks even a zero interest loan. And this will assist with covering the general running costs and salaries of your practice. So those are the two places we've kind of gone to assist practices with additional cash flow during this time. The other thing to take note of is the tax reliefs.
Ryan, somebody's just asked, as a sole prop, can you still contribute to UIF for yourself?
The short answer is yes, you can. So you would register for UIF in your own personal name. So if you're trading as an Inc., the Inc. would have a UIF number. If you're trading as a sole prop, you yourself would have a UIF number. And as long as you're contributing to the UIF on your own behalf every month, you would be eligible to claim effectively. So the UIF would aggregate your earnings over the last couple of months and assess what to pay you. But the short answer is yes, you could claim as long as you registered.
Okay, and then somebody asked, if I've already registered as a PTY Limited, how do I go about making my practice a sole prop?
If you've registered as a PTY, it would be advisable to actually switch over to an incorporation. So a PTY, although has the same tax consequences as an incorporation, is not legally allowable for a medical practitioner for it's basically malpractice insurance reasons. But effectively, you would just have to submit a change form to the CIPC and switch your business, convert it from an incorporation, from a PTY to an incorporation. So it is possible. You can actually also, you can close the business down and start trading as a sole prop if you want to. But I mean, it would just be understanding the various tax consequences of doing that. So, kind of how much are you earning? Are you VAT registered yet? All these types of things would play a role as to whether you should maybe just shut the PTY down and move to a sole prop, or just convert it to an incorporation.
So would you advise that is something you do in consultation with an accountant?
Yeah, I would. I mean, either way, you have to stop trading as a PTY, but whether you switch over to an incorporation or maybe move back to trading in your own name, would definitely consult with an accountant, particularly from a VAT point of view. So if you haven't registered for VAT yet, it's probably worth actually going back and trading as a sole proprietor for a little while and running up to that VAT threshold first, and then switching over to an Inc. and running up to the VAT threshold again, just to delay the VAT impact. But I mean, there's multiple tax factors, but I mean, the short answer is it's possible, but definitely consult with someone and consider the tax options.
Okay, thank you.
Cool. So there are various tax reliefs that have been implemented by the government. So the two major ones I'll discuss now is the provisional tax and pay-as-you-earn deferral. So on a monthly basis, you're allowed to defer 35% of your pay-as-you-earn. So for instance, if you deferred your pay-as-you-earn from May, the installments will start to be eligible to be repaid in September. So the 35% you've deferred will be payable. Installment 1 will start in September, and you'll pay 6 installments to pay that 35% off. And they've allowed the 35% deferral for 3 months. So it would be May, June, and July. You've been allowed to defer 35% of the pay-as-you-earn. And from a provisional tax point of view, you actually can defer 85% of your provisional tax payment when it comes due. So for most of the guys, that's in August coming up now. So depending on if you've made profit or not now, you can defer up to 85% of your provisional tax to 6 months' time, and then that will be repayable over a 6-month period. So, I mean, our advice at the moment is, even if you have the money, rather hold on to the money because it's yours and you can earn interest on it either in your bond or in investments, and defer as much tax as you can. There's no interest, no penalties for doing these deferrals. Just hold on to the money, and when it comes due after deferral, you can pay it back, but at least you'll be able to earn a bit of interest on holding on to that cash instead of giving it over to SARS. So these are kind of the main COVID-19 considerations. I mean, there are one or two outside of this box, but definitely, I would definitely look to, if you are struggling for cash, look at the UIF and look to your banker to get the COVID loans. They're quite accessible. So yeah, that's in a nutshell. I've condensed normally quite a long chat, but in a nutshell, those I feel are the most important points to consider for your practice at the moment. But I'm happy to answer any questions if there's anything now.